After about 4 or 5 years, plus the number of hours I was working, I kind of sat down with myself and I said, do I really want to be in the restaurant business? I didn't want to trade time for dollars. I wanted my money to work for me passively as much as possible. I knew that I wanted to have flexibility to travel. If you can apply the real estate components, right, great location, good signage, good street visibility, strong traffic counts, outposition your competition, main corners as much as you can. If you can target those and then you can apply the utilization and the demand scenarios to it, I think you have a recipe for success at the end of the day. And if you can do it right, buy your price right, and you can build it appropriately, you're going to see a benefit in 2 or 3 years because there's not enough supply coming on the market.
Welcome everybody to Self-Storage Income, and today we have a guest with us who's actually in the office. Courtney, how's it going, man?
Doing well. Thanks for having me. I appreciate it, AJ. This is great.
Absolutely. Well, I'm excited for everybody to get to know you and get to understand a little more about your background. So right now, let's kind of get this base level. Where are you from? What are you currently doing, working on, in your background? So then we can discuss everything from storage to the other commercial assets and your insight there.
Yeah. So from Indianapolis, Indiana, born and raised, grew up there. I've been in real estate since I got out of college. Been doing storage for about 4 or 5 years now. It's been a great asset class for us, but kind of had a diverse background getting to this point. Grew up in a family-owned a large sporting goods company. So kind of had that natural entrepreneurial spirit, the natural retail gravitation, for that type of sector. And when I got out of college, my dad sold his business and retired. And so it was good to see him do that. And so my trajectory at that time was I just kind of landed in real estate. It wasn't necessarily my main priority at the time. I wasn't exactly sure what I was going to get into, but landed a couple good opportunities. Realized really liked the industry, and so kind of took off from there. So my first gig coming out was worked for a company that we were a preferred developer for CVS Pharmacy. So I was, I don't know, maybe 22 at the time, and this young guy with this established kind of boutique firm, but we had a really great client. This is back in 2005, about 2006, 2007. Maybe a year or two earlier. So I'm shipped out to Rhode Island to the headquarters where CVS is. And our job was to go make deals. We were a fee-for-service developer, so we were working hand in hand with CVS Development. We were basically their real estate extension. So it was great. We got to play with their money, which is always nice. And we got to find deals on their behalf. And we were doing anywhere from $50 to $60 million per developer at the time. So, I'm this young kid kind of running around the New England market, never really been there, and trying to dig up deals. And so spent about 2 months when I went out there and got lucky and landed a couple projects. Didn't really know exactly how this was all going to unfold, but it was just kind of trial by error. And so took off from there. And so I spent the next 5 years living in Boston, did about $300 million in real estate pharmacy development. It was interesting. It was back in the heyday, being from Indianapolis, we have a clear-cut, concise land configuration, right? Everything's cornfields for the most part. You go out to New York and Boston, all these other major metros, and you're dealing with 6, 7, 8 different assemblages. So you're getting into some pretty complicated projects. Lots of reused land, so you have a lot of entitlement issues, a lot of environmental issues, things like that. Yes. So I really cut my teeth in the retail development industry. It was a combination of brokerage, but a lot of development work too. So I got really exposed to a lot of that at an early age. I like to think I accumulated about 10 or 12 years of experience in about 3 to 5. So it was great. The quantity of deals that we were doing, the scale, the sizability, and everything was perfect.
Did they scale back in 2008?
So yeah, that kind of is what led me to my next endeavor. So yeah, so 2008. So I'm working for this boutique company, and so I'm saying to myself, I think I can do this on my own. Well, 2008 happens, and my dad had a bunch of commercial property in Indianapolis where his company's headquarters was located, and so I'm thinking, so we started working together.
Did he sell the business and keep the real estate?
He did. Yeah.
Oh, genius.
Yeah.
I like your dad.
Yeah. I know.
Smart guy.
Yeah, kind of the Portillo's model. If you guys are familiar with Portillo's out of Chicago, that guy's a legend in the industry. He had 85 different locations, kept all the real estate, and did a sale and leaseback program and capitalized on the sale and then cash flowed the real estate. It was just, marvelous. But so we had about 10 or 12 acres that we were going to master develop, and that was going to be the catalyst to start our development company. Well, I transacted on the deal, bought the property from my dad right before the crash. And so now I'm kind of stuck. you know, which is interesting. You know, everything comes in cycles, right? You know, and so not that we're in that '08 crash or '09 crash right now, but, you know, we're definitely seeing some hardships. But anyway, so, you know, I'm kind of stuck. So I'm trying to figure out what my next trajectory looks like. And, you know, I'm 27 or so at the time. And my dad's like, hey, have you ever looked at franchising? So I got involved in, I think you actually have them out here now, but Marco's Pizza is the name of the franchisee or franchisor, excuse me. And so, you know, I coupled that with kind of growing up in an operational intensive, you know, family business. You know, took my real estate experience and got involved in the franchise business. Came out guns blazing. I was, you know, I made a couple mistakes, but, you know, I was young. I was hungry. I had a lot of drive. I had just enough experience to, you know, really make a go at this. And so that's what I did. And I wasn't married at the time. I was, you know, single, and, you know, I didn't have a lot of overhead. And so I worked a lot of hours. And so I bought a territory in Indianapolis, basically the central Indiana territory with Marco's Pizza, and started to open up stores, you know, handling every component of it from multi-unit financing all the way down to operations to real estate and everything else in between. You know, and that did pretty well for a few years. But here's what's interesting. You know, looking back on everything in my career, you know, everything's 20/20 hindsight, right? You know, and you start, you know, the best learning lessons I've ever had have come from, you know, mistakes and doing things that I realized I didn't really like doing. You know, and that really helped kind of create that bowling lane buffer, right? It kind of moves you in the right direction to where you want to go. And so what I realized was, you know, as a franchisee, you know, I learned about, developed a lot of experience in the franchise business, and realized that, you know, we were taking all the risk. And we were taking on all the financial risk and all the debt. You know, the company was growing. They were marketing themselves as the fastest growing pizza company in the United States, which technically was true, but they were building that on the backs of the current franchisees. And so you were supporting financially a lot of their growth plan, you know, through TV advertising, national marketing campaigns, you know, and things like that. And so after about 4 or 5 years, plus the number of hours I was working, I kind of sat down with myself and I said, do I really want to be in the restaurant business? Now, I was in the restaurant business, but I was trying to scale it to a multi-unit ownership. And the other thing I learned was, you know, you don't have assets. You know, and, you know, you have pennies on the dollar worth of restaurant equipment that is dime a dozen, you know, easy to find. You know, you're in a very volatile cash flow business that is susceptible, not necessarily to recession, but to competition, you know, placement in the marketplace. You're also susceptible to the ebbs and flows of what the franchisor wants to impose upon his franchisees, you know, price point competition, things like that. So, long story short, I decided, you know, it's time to cut bait. I was 31 at the time. And so I sold that company. And it was more or less, I kind of got out, you know, by the skin of my teeth, you know, and a lot of the people that were still in there that, you know, friends and colleagues and other people that were throughout the country, I think, some of them did well. You know, they made a go of it. But I think some were, you know, probably held on a little too long. You know, and so I was kind of glad to get out. It was not my passion. And that was the other thing I learned. You know, you got to follow your passion. That's probably one of the most important things. It's critical because this business is hard enough. If you don't have that internal drive to really want to do it, that it's not sticky enough to get you through those dark times, right?
Absolutely.
You know, and so you have to be really driven.
Yes.
So that was probably, you know, my second major learning lesson in my business career. And so I got back into real estate. You know, I got back into what I knew and what I enjoyed and what I liked. And so from there, I got into brokerage and got in commercial brokerage. I technically did that in my experience with CVS and pharmacy and doing stuff like that. And there was a little bit more on the development side, but I had built a lot of contacts, you know, both in, you know, the eastern side of the United States and you know, I had a lot of contacts, a lot of relationships that I was able to utilize. And so we had started a brokerage company in Indianapolis, and it took off from there. And so I'm coming out of this business. I'm recently married, starting a new company, which that's always fun telling your wife that, hey, I'm, yeah.
Oh, yeah.
Hey, guess what? I want to start a total new endeavor. I have no idea where our cash is going to come from, you know?
Yep.
my wife, who's very conservative, comes from a very conservative family, who's used to, saw her dad who works, a W-2 job his entire life, wait for the retirement plan at age 65. This is what you do. You work for the same firm for 25 years. You put in your dues, and that's the American dream,
Yes.
And so that's what, that was my wife's experience. And I said, well, we're going to take a different approach. We're going to take a risky approach and go start a new company. And we're going to start a company that's reliant on commissions and reliant on finding clients and finding, that niche. And she said, okay, let's see how it goes. And so, I got, through perseverance, some luck, and just some sheer grit, we did really well. And started making a name for ourselves and started building that business up, and landed some really high fluent clients on the national side. And that was all retail focused. So this is in 2014, 2015, 16. And so we're coming into the age of Amazon, right?
Yes.
And the disruption in the retail market too. And so retail was taking a drastic change, something that we hadn't seen before. The consumer-driven product consumption protocol has drastically changed at this point. And I don't want to just blame Amazon, but the B2B consumer industry and the acquisition of products and everything started to evolve drastically. You couple that with
Fast.
and fast. And then you couple that with COVID.
Yes.
And we saw the most dramatic change in the commercial real estate sector across the board, from storage to office to, industrial probably weathered the storm a little bit better. But even with the supply chain disruption, everybody saw this massive disruption. And what was it, 2018? And I got to give credit to you, AJ. I was listening to one of your podcasts. And I'm sitting and I'm driving. I remember exactly where I was in Indianapolis, and I'm driving to my office, and I'm saying to myself, okay, we've got this business, it's going well. But I knew where net worth was derived from. I knew net worth was derived from ownership, equity, long-term plays. And I'd seen enough, and I'd been around long enough to realize that was the trajectory I wanted to go. But the brokerage side, you're trading time for dollars, right? And you can have a great life. You can have a great career, and a lot of people have, but I didn't want to trade time for dollars. I wanted my money to work for me passively as much as possible. I knew that I wanted to have flexibility to travel. What I didn't realize was the dramatic change that COVID was going to have on the work-life balance industry across almost every sector. In today's environment, if you told me 10 years ago that you could basically, in my industry, live and play and work wherever you want, and those two things do not have to be symbiotic with one another. You can separate your personal life from your business life and work in separate arenas. I would have said, I think that's probably several years out, but it was fast approaching, and I don't think that I understood. Maybe a lot of people didn't understand the dynamic change that was really approaching the United States and probably the world for that matter. So, with all that said, I was driving down, heading to the office, and I'm scrolling through podcasts, and I see this one that says AJ Osborne, and I was all right, let's listen to that. Nice picture, by the way.
Thank you.
Yeah, on the front. So all right, so we started listening to it, and it's funny. I remember thinking to myself, I'm like, in commercial real estate, you have multiple sectors. You have industrial, you have multifamily, you have finance, you have retail. And then you have some of the specialty areas, some others, but those were the core four, and then you had some specialty areas, like self-storage or, student housing,
industrial,
exactly.
Industrial, yeah.
And I remember listening to your podcast. I'm like, man, I'm in retail. Retail's the sexiest of all this.
Yeah.
Storage is not sexy.
Mm-hmm.
So I kind of tabled storage for a while, and then I don't remember exactly how this happened, but from there, what I ended up doing is in addition to running a brokerage company and doing all that, I got involved in acquisition of mortgage notes.
Yeah.
So I found a niche where we could buy these mortgage notes from hedge funds. And by the way, I realize this is deviating from storage. I'll loop this back in real quick, but I found a couple guys, and I called my best friend, who is a football coach out in Kentucky. We've been best friends since we were 6. Trust the guy with my life. And John, it was funny. I was I developed this plan with another guy. What we would do is we'd buy these mortgage notes from hedge funds, and we'd buy them at a 15 to 20% discount, maybe a little bit better. But they were A and B tranche type mortgage notes. So guaranteed repayment, little default rate, and then we would turn around and we'd split the mortgage notes in half. We would segregate the amortization schedules and sell the proceeds to another investor. So basically, you got a mortgage note that's got 300 months remaining on the term. We would buy it for a 20% discount, turn around and sell it to the next 250 payments to an outside investor, and it was a coupon cutting return. They would get 5, 6, 7, 8%, and we would get all of our money back, and we'd keep the back end of these mortgage notes. So if you accumulate enough in 10, 15, 20 years, you would have a bunch of these notes, just materialize. And then if they refinanced or if they sold the house, you collect that money quicker. And so we were playing the role of the bank. And it sounded great in theory, but what I lacked was experience of raising capital.
Yeah.
And I understood all this stuff, but I was going out to the marketplace and tapping into all my contacts and trying to explain this stuff to investors was really challenging.
Yes.
Really challenging.
Yes.
Even guys who, were, worth millions and millions and millions of dollars, developers that I knew, guys that were in the real estate industry, and they would say, so you're telling me I'm not going to own the property? I said, yeah, you don't own the property. You own the debt. You own the note. You're the banker now. And, trying to convey that to people was actually a lot more challenging than I thought. That was my first experience in trying to do any capital raise. Where we actually found some success was through my partner that I brought in. His name is John Clark. And he was a head football coach, or he was a football coach in collegiate athletics. If anybody knows anything about coaching football in college, you're working 100 hours a week, in and out, and you're making great money, and you don't even have time. Your skill set is not in how do you manage your money. Your skill set is in the X's and O's of winning a football game. So you got guys making, $600, $700, $800 million a year, and they don't know what to do with their money. And so we tapped into that sector. And so we raised some capital, bought some of these notes, but it was not at the scale and velocity that we really wanted to do. Plus, the other thing it did not generate was the cash flow. This was a very long-term strategic play.
Yeah.
And so one weekend we were sitting down, we were having a brainstorming session, and so we went down to Kentucky, rented an Airbnb, and we said, okay, we're doing this note. Courtney, you have this company over here. You're doing brokerage. Obviously, we're trying to get in investments and trying to build equity and things like that. And I said, John, you're coaching, football, but clearly he has a mind for this,
Yes.
just because, it kind of deviated a little bit. I think the education system needs a total overhaul, right? Absolutely. I know a lot of people who've gone to, some of the top schools and can't do anything. And then I go to my buddy who's a head football coach, and he gets this like that,
Yeah.
And so I knew that we had the right partnership. So, we're kind of put everything on all the cards on the table. And then we said, where do we want to put our focus? And by the end of that weekend, we said, let's land on storage. The notes were great. We can still do that, but we need cash flow.
Yeah.
We need cash flow. We need cash flow to be able to grow. And, I said, I don't know anything about storage. He goes, I don't either. Let's learn.
Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird, because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
So just like any success story, you go out and you figure it out on your own. You start you start reaching out to contacts who've done this. Stand on the shoulder of giants is really was our mentality. And I like to say that I'm sure it didn't always come across this way, but we took the approach of a humility standpoint more so than we know what we're doing.
Yeah.
Because we didn't exactly know what we were doing. This was a completely different business model from what I was used to.
Yeah.
But I got back into some of your podcasts and I started looking at some of the numbers that these things can generate, and I was astonished. So from there, what happened was we came up with a business strategy, and that was in markets like Indianapolis, the larger scale markets throughout the United States. What we saw were all these REITs and these institutional players and larger scale players were kind of battling it out. And so we said, let's go to the tertiary markets. I think, and this was just kind of sticking my finger in the air, making a speculation, was I think that we can go build a portfolio in some of these tertiary markets. And from there, when the competition's too fierce in higher end markets and top tier markets, they're going to start, gravitating towards some of these smaller areas. And so that was what we decided to do. And so then from there, we're like, okay, what market are we going to land on? Well, Johnny was, he's like, hey, we live down here in Kentucky, south of Lexington, not too far from Lake Cumberland and Somerset. And so he goes, hey, you know what? When my wife and I moved down there, his wife's from there, by the way. And he goes, we bought a boat. And he goes, and we wanted to put it on Lake Cumberland. He goes, I had to park my boat an hour away from Lake Cumberland.
Yeah.
And we go, that can't be right. There's a gazillion self-storage places down there, boat and RV. I mean, it's loaded with them. So we drove down there and we spent like a week going to all these facilities, and we're like, there is not a facility to rent from. We're like, this is amazing. So this is in like late 2018, I think, give or take.
Yeah.
And so then we started diving into this. We're like, man, maybe we're onto something. I remember driving up to a facility, not a great one, but at the time we didn't even know what a great facility was.
Yeah.
We're just like, we're going to buy something, but what's a great facility look like? And so we're standing there and they had one empty unit. And I remember opening up the unit myself, and all of a sudden this guy pulls up and he goes, do you guys own this facility? We're like, no. And he goes, I want that unit. And I asked him why. He goes, I can't find another unit anywhere nearby. So we're like, I think we're onto something. This is before we even knew what supply and demand ratios were.
Yeah. It was just, you're in the market, you see it, you understand.
Yeah, exactly. So we call a buddy of mine who's out of St. Louis, and he was a broker, and he was doing the same thing we were doing, but more on the brokerage side for storage. And we said, hey, look, here's a couple leads. Go find us a deal. So he called us up and he found us a deal. Now, mind you, Kentucky is a little bit different world, especially the area we're playing in. If anybody's seen the movie or TV show, The Ozarks, very similar attitude down there. I remember, it's only a 4-hour drive from where I live, but the moment you cross over the Mason-Dixon line, the dynamics change. Yeah. And so I remember going down there, and a couple times, some of the people would be like, they knew I was up from up north, and they're like, man, Courtney, you talk way too fast, and it wasn't like a education standpoint. It was just, I wasn't part of their culture,
Exactly.
And so we found a facility, actually two. It was called 914 Storage in Somerset. And we're underwriting this thing. And I'm thinking, hey, I think we have the underwriting correct. What we came to find out was our underwriting was vastly underwritten, and, well, the other interesting part, so we're negotiating this contract, we're back and forth, and then we're trying to raise capital. We found a capital partner, and came in and said, I love it. He said, I love your business strategy. I love your business model. Let's proceed. So we landed the capital, found the financing, found the deal. So now we have the algebraic equation laid out. We have A plus B plus C, and now we can make everything balance. So right before closing, I remember going through this, and I'm sure you've seen this a lot more than I have. There was a discrepancy between the cash and what he's reporting, and the funny thing was, he calls me up one day and goes, Courtney, I assure you, if you close on this, you'll see it will materialize. And so we took a chance, we closed on it, and it did gangbusters. And so we were like, this is amazing. So we were really happy with that. The one thing that we realized that we were going to need was operations, because as soon as we closed on this facility, we were like, let's go find more. So we started building a portfolio in this market. And from there, we had accumulated 2 or 3 more facilities. And then at the same time, my company up in Indianapolis, my other partners, I'm telling them about this, and we're all in the retail sector, right? And I'm telling them about this. And so we decided to buy in Indianapolis now. And so we found a facility that's 50,000 square feet. We added 45,000. So now we're getting into the development game. We exited out of that in, I think, 22 months, did really well on that. We found 2 more in Indianapolis. And so now we're growing this company. And all of a sudden, things are starting to take off. But we all kind of had these side businesses, right? Or our main businesses, and so storage wasn't necessarily our main focus. So over the past couple of years, I decided that storage is where I'm going to put my focus. And so we built a portfolio of about 11 facilities in the Kentucky, Indianapolis market, or Indiana market, about 750,000 square feet. Under ownership and management. We partnered with Extra Space on our larger institutional products, and then we self-manage the rest. And we're in the process right now of unloading some of our portfolio. We've got some changing dynamics amongst the partnership, but I'm still moving forward. We've had good experience with Extra Space, but at the same time, I see where there's some inefficiencies. That's a whole separate conversation. But anyway, long story short, I guess that's kind of how I ended up here.
It's interesting to see the evolution too, because your background very similar to mine. I've done a lot of different businesses. I've been a franchisee. I have tech companies. I have product companies. I have service-based companies. Right. I have storage, and then I have other assets. Obviously, educational businesses. There's kind of a wide array, and so. When I talk to people a lot about storage, it's not because this is my thing and this is what I know and I don't really know anything else.
Yeah,
that's not true at all. It's storage wasn't what I was originally doing. In fact, even when we were doing storage, and as we were doing it, I did not think storage would be the thing. Mm-hmm. I thought it was going to be all these other things. So we were doing it, but I was doing other things, right? And so we could see the pros and we could see where it was going and why it was good, the long-term value. And, you have kind of a very similar background and you understand those positives and the negatives because there's no such thing as an asset that is perfect. I've been telling people for years that this whole idea that self-storage was recession-proof. I literally would lose it. People in my office and around it said that that's my trigger word is when people would say self-storage is recession-proof back, and 20.
We heard that many times.
Yeah. And it was like, I would lose my mind. But it is when you compare it and actually look at the assets and when you compare it to other industries, it is clear that there are a lot of really strong positives that are disproportionate to the negatives. And that's the thing that I found interesting, where the upside and the benefits of it were very disproportionate to the downsides, where in a lot of industries and assets, the upsides may be awesome, but the downsides are very proportionate to that, right? This idea that, in order to make more, you have to risk way more. And absolutely. I don't like that narrative because it means that there's an exact correlation. And I don't think that's necessarily true. And I think good business people also disagree that that's true. And there's nothing you can do about it. It's like that viewpoint of you're just gambling. And storage was kind of that thing that set apart. I was like, I can see all this upside and everything, but I can see where the downside is, how we can manage it. But even not managing the downside, it was still disproportionate to the upside. And the long-term evolution of it was very clear, where it was like, this is a need. There's fundamental drivers, right, which make up for a good industry. Now, as you get into it, that doesn't take away the fact that you have to learn and that you are a main component in the success or failure of individual assets and facilities, and that will never go away, and you'll never be perfect also. So there's, this coalition of experience actually failing while doing it, actually being successful and putting those things together. And I think that can not just surprise people, I think people generally know it, but can wash people out pretty quickly. And you've had an experience where you went to 11 facilities quickly. So talk to me about the ones that were really good and the ones that didn't play out how you thought they would. And what were the difference out of those 11 ones to the ones where you're like, that was amazing, and this one, it just didn't do what we thought, or we made mistakes or whatever? What were the differences that you could see between those two?
Before I answer, I agree with you on your business philosophy with the risk reward scenario, and that's one thing where I really learned that was when I was in the franchise business, right?
Yes.
You know, I saw the risk that was being calculated. I saw you can only generate so much yield out of a restaurant. Like there's a baseline, max on, what your EBITDA is going to be and what your net profits are going to be. I mean,
and very hard to scale.
The scalability is predicated upon the number of units you can develop, right?
Yes.
And every unit it has a lot of susceptible variables that can impact that business. So that's really where I learned that. I applied that approach to the real estate side going forward. An example is you're buying a shopping center. Okay. Let's say it's a 100,000 square foot shopping center, but you've got 30% of it restaurant-based tenants.
Yeah.
And then you've got maybe an anchor that is susceptible to downturns in the economy, like Big Lots or somebody like that. And then you have all these co-tenancy, all this language that is co-tenant based, that is all your B shops are predicated upon that anchor surviving. And we saw in COVID that these big anchors have to change their business model, and a lot of them did. And so then the entire valuation of your shopping center really was depleted. So looking at those risks and variables, I think is really critical. But so I do agree with that. But going back to your question on the pros and cons, what we did right, what we didn't do right. To answer that question, our baseline was measured during COVID years.
Yeah.
And for anybody in the business, they understand what that means. We started where just about anybody was making money in storage because the demand was so high. We didn't even understand what revenue management was at the time because we're just like,
jack it up. Yeah, exactly.
Yeah. Hey, 10 by 10 is just, $100. Let's make it 150.
Yep.
And, just like, once again, sticking our finger in the air and, gauging where the wind is. And that's how we kind of managed it. So our baseline was established during COVID pricing improvements and all that. So I think that kind of set the expectation a little bit high. Not that we weren't having success, but that led us probably we did two deals that we shouldn't have done in our portfolio in Kentucky, and they were boat and RV deals. At the time, boat and RV sales were at the peak. They were at the apex of their industry, right? You saw more boat transactions anywhere. We saw the volume of in Lake Cumberland has 4 million unique visitors a year, roughly. That's what they advertise. And we saw an influx of that, increase by 20%, or 10% at least, I think 10 to 15%, I think was the number. And so we saw the demand for boat and RV facilities go up. So we bought a piece of ground. We said, we're going to develop this. So we got in development. And what we also noticed in the market is there's no, what we considered at the time, a Class A boat and RV facility. None. Most of them were, in fact, we looked at one that was separated by chicken wire.
Yeah.
And the guy's like, I'm 100% full. He was just a farmer. He had a wedding venue on one property and then, 50,000 square feet or whatever it was.
Yeah. And
we looked at it and it was on a slope with chicken wire. And we said, man, if that guy can make it, we can. But we saw, but at the same time, we saw people who had, six-figure boats, $100, $200, $300,000 boats that they were taking down to Lake Cumberland. And in our thought, it's like, there's no product that's matching this, that's matching the income levels that some of these people have. So we built a facility, it was high end, and we had to fire our contractor. And so we brought in another contractor. So that set us back about 6 months. So first lesson in that was make sure that you have all your contractors lined up appropriately and you have trust and faith in them. Because if you get a delay in that, especially on variable interest rate loans, at the time, loans were coming in at 3.5%, 3 3/4, but what we didn't anticipate was the massive increase in the interest rates, right? And so anyway, that's something that was a mistake on our part. Now we completed the project and it's doing reasonably well. We've seen an uptick. We're still in lease up phase. And then another facility we bought in facilities 117,000 square foot boat and RV. It was on year rents, and not that we wouldn't have bought it, but I think we overpaid for that one. Once again, we got caught in the interest rate hike. Yep. So we had to make some adjustments through that period.
Yeah.
So that was another mistake that we made. Where I think we really started to accelerate is we kind of start changing our business model. So we still liked some of the tertiary markets, but we started playing in that upper scale market tier, that higher end tier of markets like Indianapolis and Louisville and Columbus and St. Louis, things like that. But Indianapolis specifically, because that was our backyard. So where we really started honing our skills was our underwriting, and trying to make better calculations on, because now we're starting to come, we're on the tail end of COVID, or maybe in the middle towards the tail. And we're starting to realize that the COVID period was a fluctuation that we will never see again.
Yeah.
We don't know what it's going to look like 2, 3, 4, 5 years down the road, but we know this is not the baseline to go forward. So we started making some adjustments there. We started making adjustments in our operations and things like that. The one other mistake I think that we made is that we have 8 facilities in the Somerset market. And I think we were the creation of our own monsters to a certain degree, meaning people saw that we were doing, and we were in an unsophisticated market where there was no revenue management, right? And so we became the biggest player down there. So we could drive prices, but you could only drive prices so much because everybody saw what we were doing. And so you had people who had, there's a lot of land down there. So we saw people building 10, 15, 20,000 square feet of their own storage just off the side of their property. And so the supply started increasing. That was not something that we anticipated. So we weathered those storms. We got through it. We've seen an increase in our occupancy. We've seen an increase in our rental growth, but probably not the same trajectory that we would have saw during the COVID periods.
Yeah.
So those were the couple of mistakes that we made. But then we started changing our business model and doing some more Class A facilities. We started applying our real estate approach, right? Main on main, outposition your competition, have a better mousetrap than everybody else.
Yep.
Because you can't control competition. You
Nope.
got to look at the things you can control. It's like the Navy SEAL motto or wherever it came from, control the 3-foot radius in front of you. That's about all you can control. So we started applying the things that we could control, and that was good real estate decisions. So I think that helped us out.
I love that. Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number 1 on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make. When you are looking now today with all the changes and everything, what is your thesis now? Moving forward, what do you see? What are you trying, your direction, that outlook in how you're going to apply those efforts into those 3 feet? What are you focused on doing now?
Yeah. So great question. I mean, just like anybody says, if I had a crystal ball, right?
Yeah. Uh-huh.
Right now, I think we're about to see a release of pent up demand across the board. I think everybody would agree that rates have to drop at some point, despite whatever administration we have coming in.
Yeah.
Once again, go back to the factor of what you can and cannot control. My single vote can't control the administration, but I do think the Feds are going to cut rates again. I think that's going to open the floodgates because you have a lot of dry powder sitting on the sidelines.
Yes.
And so the question is, where can you place it? And the other thing I think has happened is, because of COVID, you've had this hangover effect of what true valuations are on properties.
Yes.
And so we're starting to see a reset, a much needed reset. And we've had to get through it full since Q2, Q3 of 2023. We've had to get through this lull of a reset pattern, right? Yeah. To be able for those valuations to drop and people to come back to reality and expect what's going on in the marketplace. So I've changed my business model from less so of a merchant developer to where we're buying, acquire, improve, expand, and then exit out in a 2 or 3 year, exit plan. That was easy to do when people were paying, a 6 cap on year 2 or year 3 NOI.
Yeah.
You're getting ridiculous pricing.
Yeah.
Now the model is long-term holds. We want to be able to stay in this, generate cash flow for our investors, refinance, restructure the debt, get our investors money and pref paid out, and let these things cash flow for a 10-year period, maybe longer, build a nice portfolio, take advantage of all the tax breaks. That's another thing, who knows where taxes are going to end up, what implications are going to happen from there. So we want to be able to use the passive cash flow and pay off, and use the refi strategy and do a long-term hold on these. From a long-term standpoint, I don't see online commerce going anywhere. And it's kind of like what we were talking about earlier. We were talking about sugar, right? I think people get addicted to patterns and behaviors. Yes. And the behavioral pattern of online shopping and e-commerce is only going to further strengthen that consumer buying power. And then if you drop rates on top of that with the pent-up demand of housing, the housing market, you're going to see this not to maybe the same scale, but you're going to see this mass migration of housing growth, occur again. And that's going to be another spike in the industry. And I think the storage industry is going to benefit from that.
Yeah, I agree. I think it's, the pent-up demand, and this is something you see in every different cycle, that there's pent-up demand, but more importantly, the supply level. So then you have this supply is not reaching, it's not hitting, it's not doing what it's supposed to do. And that exasperates and it resets at a new nominal. So like we have lower expectations, there's lower supply, you have hurdles that stop supply, that contracts those supply even more. And then that's coming off a high, right? It just swings that other way. And so that creates that pent-up demand and it rebuilds upon itself. And this is something that real estate cycles, right? It goes through it. And the idea that people are like, oh, it'll never go, right? It's, well, it always does. It's just part of it. If there's a utilization is there, the amount of utilization is all we're talking about. So the utilization is there. What are the things that impact utilization for customers? For self-storage, the things that impact utilization is is the actual moving. So demand drives from people needing space for shorter periods of time, and they're normally in transition, or they need to utilize a lower cost space. So we see more businesses, right? All that kind of stuff doing it because it is an economical issue, or it's purely driven because of ability. These things are the drivers. Well, the overall moving and transition one, that's where the demand's been hit the most because of high interest rates. So that is that input to overall utilization of the asset, which has contracted it, which means demand has gone down. But the question becomes, is that ever going, like when I look at it, is it going to go back to what I air quotations normal, and not talking about COVID, or is it going to, continue down like people are like, oh, self-storage is dead. I'm like, all you're doing is looking at short-term things to try to make long-term outlooks, and you're looking at the asset's trends. You're not looking at the drivers. When you look at the drivers, not only have none of them gone away, it's very clear on what's creating lower demand. Once again, with that said, most of it has only to do with the selling or the buying of the asset, right? Our assets are all doing better. So our revenue is up, our occupancies are up. This spring was a really good spring. So even a new normal, we're probably moving more into it. And that's with one of the three legs that drive utilization being contracted really hard. So the question is, will that leg change? And the answer is yes. Obviously, the housing market will go up again. It'll also go down again. That's just a normal part. So with that said, it's obvious the utilization of our asset is still in need. It's going to be in more need. Then what are the things stopping it? Those are external factors, not internal. And when you look at the real estate cycles, that's how you can look and see where we're at, right? And so I think you're exactly right. We know what the utilization will be. We can see it. This allows us to look at different markets and say, where is the utilization contracted, but supply is contracted, right? And so we have great opportunities.
Yep.
And we're not predicting markets. We're looking at utilization like a business. So where do customers need our product and how much are they willing to pay? I'm not talking about predicting markets, right? And that those fundamental things are actually easier to see today than they were for the last 5-6 years. So you can actually make way better decisions today, way better. People are like, it's not a good time. And I'm like, it's actually a way better time because I can see, we were going over that in our revenue management. stuff that you were part of yesterday when we were talking about when we're like, look at the individual units and you could see this one is at 100% full. This one's at 60% full. This one's at 85 and this one's at 75, right? We had a period of time from 18 to 22. It was 100% full.
Yep.
And the only reason was because people couldn't get that unit. So they bought something they didn't really want.
Yep.
So you couldn't actually see what demand was. We couldn't actually tell what our customers really wanted or didn't want. That's really bad.
Yeah.
Right. And today we can see it. It's very clear. So we can make great decisions.
That period was caked in makeup. You couldn't get a true reflection of what the imagery looked like.
Absolutely.
I agree 100%. And because we kind of were born out of that sector, we've had to make some pivotal changes into our business philosophy. But, if you look at it from a holistic standpoint, I mean, the industry is a massive industry.
Massive, yeah.
Consumerism is not going down. I mean,
Nope.
No matter what, we are the largest consumer in the entire world.
Yeah.
That's not going down.
It's only gotten cheaper and easier. And that is what drives everything, even in the world economy today.
Yep, yeah, absolutely. So, you dovetail that with like you said, the utilization and the demand. I think the other thing that we were talking about earlier this morning is new supply. And while capital and financing is certainly gotten more challenging, I get that, but there's not a lot of new supply coming on the market. And if you can balance out that equation and find capital and be able to take advantage of that lack of supply and new supply that's coming on the market, we're not talking about a 5 or 10 year period. I think in a 2 to 3 year period, you can see huge advantages from that, especially in markets if you're pinpointing the right location. My experience, or I guess what I understand storage to be before we got into it was, I don't know if it was less real estate driven and more supply and demand driven, but if you can apply the real estate components, right? Great location, good signage, good street visibility, strong traffic counts, outposition your competition, the main on main corners as much as you can. If you can target those and then you can apply the utilization and the demand scenarios to it, I think you have a recipe for success at the end of the day. And if you can do it right, buy your price right, and you can build it appropriately, you're going to see a benefit in 2 or 3 years because there's not enough supply coming on the market. When everybody's zigging, I think when your guys is talking about, when everybody's zigging, should we be zagging? Yeah. And I do believe that, I never want to be one that's always following the herd. Kind of the reason why I did get into the storage business, because, in my line of work at the time, everybody's talking about shopping center acquisitions, right? Or everybody's talking about multifamily. Yeah. And I said, well, kind of comparing it to the retail sector. So, we have, ISS and all these different storage conventions. If anybody who's ever been to ICSC, which is International Council of Shopping Centers, which is all retail oriented out in Vegas or Chicago or New York, those are some of the largest conventions. And you go out there and there's 10,000 identical players to me.
Yes.
You go to some of the storage conventions and there's a fraction of that.
Yes.
And then you look at that number, how much can somebody build in comparison to what the demand is and how many markets are available? The competition is significantly less.
Yes.
Significantly less.
Yes.
So that's where I think I do see a lot of opportunity. Now, to get from point A to point B, right, on a ground up deal and new supply deal, it's going to take some creativity and it's going to take some diligence and working with the banks and lenders and finding the right capital partners who have that tolerance. Yeah. But I think the upside is tremendous.
I could not agree more. And it was one of the main things that attracted and still does. You have mom and pop, less competition. You have good fundamentals, good margins, and more upside than there is downside. Those things are just not the equivalent. And that's a recipe for success. And then, when I look at it, in order to be successful, a lot of people know my margin of stupidity, and that all that stuff comes into the industry. Everything else is, when I looked at other industries like multifamily, things like that, I'm like, there is no room for stupidity.
No,
none. Like if you are not the best, you can get into trouble really quick. Yeah. And I'm like, look, I think I'm a smart guy. I think I'm a good guy, but I don't know that I can be the best. Right. Yeah. And I don't want to have to bet on me being the best. I want the forces to be in my favor and me to be able to have enough allocation of inputs that allow me to be me and still be successful. And that is my hedge, right? That is my ability to say, I can get better. We can learn as we go because I understand I will make mistakes.
Yeah.
And when you're a newbie, this is really important. So when I was a newbie, I'm like, how in the world can I expect to be at these levels when they have 30 years? I don't. Storage allowed me the opportunity to do that. So as well as you. And I think that's awesome. All right, man. We could obviously talk all day here, but
Sure.
Tell me, where can people go to learn about you? Where can people reach out, contact you? I'm sure you're going to have lots of questions, but where should we send people?
Yeah, absolutely. So Resolute Ventures Group, resolutevg.com is our company. We're always setting up new partnerships and new strategic structures. Telephone number is 317-995-2187. And, we're always looking for new opportunities and new ventures. And, we're looking across the board right now. So yeah, feel free to reach out to me with any questions or anything I can help with.
Well, and I appreciate you being in the office. That, obviously we were doing other stuff, and this makes podcasts just, it's easier, right?
Sure.
It's way better, and I think the audience can hear it. So thank you for coming in. Thank you for sharing your experiences and your knowledge with everybody. It's greatly appreciated.
Hey, thanks for having me. I really appreciate it.